This conference will now be recorded.
So you will remember that first day of class, this is what we looked at. There was a financial accounting theoretical framework, and this framework essentially tells us that there are four statements that we prepare: an income statement, statement of retained earnings, balance sheet, which you've learned how to do the first three, and a statement of cash flow, which we will get to in about a week's time. A company does not show journal entries, it does not show T accounts, it does not show a trial balance. So as you look at a company, as an external person look at a company, they have to see everything through the income statement, statement of retained earnings, and the balance sheet, and of course the statement of cash flow, which we'll get to. The income statement shows revenues and expenses for a particular period. Statement of retained earnings shows how much of the income is retained in the company, which is the net income less any dividends. Then the balance sheet shows you, okay, we had income this year and other years. Where are we in terms of the assets we own, the liabilities we owe, and the stockholders' equity? That's like you personally. For 2020, you had income. You file a tax return based on that income. That's the purpose of the income statement. But another question is, okay, at the end of 20, what were your assets? What were your liabilities? And then what's your equity? So those are two different things. The income for a period, and then where do you stand, with all the income that you've made? Okay. And so investors, creditors, suppliers, tax authorities, management, and employees, they only see those financial statements. So you've got to understand really how the statements prepared and be able to interpret and realize what they're used for. And so, like I'm happy that most people now can do that. Different from a lot of students in business schools nationwide. But this is the foundation of everything we do. And so you don't want to go around saying, well, I don't understand math, I'm not good at math. No, it's adding and subtracting. Now we get into, okay, what are the generally accepted principles in terms of, how do we prepare these statements? What do the journal entries represent? And so the Securities and Exchange Commission came into being in the 30s, 33, after the Great Depression, where they didn't have any generally accepted accounting principles, and everybody did whatever they wanted to in preparing financial statements. And so they basically inflated assets and everything. And so we had the Great Depression. Helping them now with the statements and doing a lot of the work is the Financial Accounting Standards Board. These are the practitioners as opposed to government employees. They typically got a better perspective. And so the FAS, the Securities and Exchange Commission, really depends on the FASB to really develop the statements journally. There's a Governmental Accounting Standards Board. You can remember not many years ago that there are a lot of municipalities that went bankrupt. So we need standards for them. Then we have IASB, the International Accounting Standards Board. And what you have to realize is that we need comparable statements across companies worldwide, because investments are made not just in U.S. companies, but in companies worldwide. And so the International Accounting Standards Board tries to lay out, and they work with FASB, but statements that are going to be uniform worldwide. So when you see a financial statement for a British company or a French company, you know that it's prepared the same way. So you should understand these four governing boards: Securities Exchange Commission, Financial Accounting Standards Board, the Governmental Accounting Standards Board, and the International Accounting Standards Board. You should, be familiar with those, as you will be tested on those, as well as these 15 generally accepted accounting principles. So there are more, but I just list the key one. The first one, the business as a single entity concept. A business is separate from you, okay? So when you're running a business, you keep it separate. We have sole proprietorship. This is the small unincorporated business, and we have partnerships. These are small businesses that don't have there's cost of doing business as a corporation. So if you got a real small company, you will go ahead and do it as a sole proprietorship or as a partnership with one or more people. To cut down somewhat on the cost, we have these limited liability companies, because if you just have a sole proprietorship or if you have a partnership, if anything happens, you got unlimited liability. They can go against everything in the business as well as all your personal assets of your entire family. So most times companies operate as corporations. Then we have some smaller corporations, sub S. But when you operate as a corporation, you're not if something happens in the business, then the company can't go outside the business to really take assets from the owner. So they're separate. Now, to practical purpose, sometimes they'll make you sign that they can go against your assets. So proprietor, partnerships, limited liability corporations, C corporations, small business corporation. You should have covered this in your legal environment course. The specific currency principle. Financial statements have to pay a specific currency. And if you're in the US and you're doing business abroad, then the foreign, your results, financial results in foreign countries has to be converted to US dollars. So we can't add US dollars and French dollars and Mexican dollars and Brazilian dollars. We have to convert those dollars based on exchange rates to US dollars, so you understand what's going on. So that's a very important concept. Time period, a simple concept. Financial statements are prepared as over a specific time period. Income statements typically run for a year, sometimes 3 months. Balance sheet are reported as a certain date, typically at the end of the year. Historical cost principle. This is what happened with the Great Depression. We record assets at what they cost. And if they've gone up in value, such as XYZ purchasing land for 100, is now worth $2 million. Well, we don't know if it's worth $2 billion. So the balance sheet should only reflect that 100,000. We keep items at historical cost. We know what the cost. We don't know if they're worth this or not, and this could be swampland in Florida. And when you form a corporation, you can sell the stock all across the U.S. So somebody in Kansas City might want to invest in your company. Well, they can't go down here and know that your Florida company really has swampland. And so we keep it at cost to protect investors. So as an investor, as a Texas investor, you can be investing in companies all over the U.S., all over the world. And so we want everything to be at historical cost, because people will overinflate numbers. Full disclosure, if something is going to happen after the balance sheet date, okay, we have December 31st, 2020. If you remember, BP had that major spill in the Gulf. And so let's assume that that happened, even if it happened in 2018 or 2019, and lawsuits are going on. When BP prepares its financial statements for the end of 2020 and for 2021, it has to estimate what those lawsuits are going to be. What is the dollar amount? If that were not the case, then people would be unaware of that. And so that's a major spill. You know, a lot of people would know, but you know, BP, people in Japan, people in China, people in Indonesia, they can buy BP stock. And so they might not know about that. And so BP has to disclose that. And so that's going to be true of all companies. Now, if the issues that we occurred in Texas, you know, those items did not occur until 2021. And you may be preparing your December 20th financial statements, but suppose you had a major loss because of the power outage. Then you got to reflect it on your statement. You can't wait till the end of 21. On your balance sheet, you got to say, well, we suffered a big loss at the end, you know, because of this freeze. And even though we're preparing the statement after December 31st, 2020, these are some items that happened after 2020 that are major that you should know about before you invest in our company. We have a recognition principle. We recognize income when it is earned. But we're going to recognize income and review expenses when they are earned. Noise here. Okay. The going concern, we typically assume that the business is going to continue in operation indefinitely. Then we have the matching principle. Somebody's on break here. BJ, please keep your mic off. Thank you, DJ, whoever. Okay, so with this matching principle, which reflects what we're getting ready to work with for adjusting entries, the matching principle says if the revenue has been earned, we need to match the related expenses. So let's assume workers are paid monthly on the first day of the following month. So in December, revenues of $400,000 generated. The workers are owed $75,000, but they're not going to be paid in January. The matching principle requires that an entry is made so that the expenses of December are going to be recognized in the same year as the income. Okay, it's going to be recognized in the same year. Principle of materiality. We don't correct for every small error. We just look at major errors. Kind of like I grade. When I grade you, I don't look at every little item, but I look at the major things. We talk about conservative accounting, historical cost. You want to be conservative when you do accounting. You don't want to be overestimating things or using estimates. Industry practices constraint. Different industries have different ways that they're going to do financial statements at times that's going to reflect better for them. Banks have a way that they account for items. Insurance companies have a way, and the energy companies. So just so if you're in an industry that has special rules, then you follow those. They won't follow the generally accepted rules at times. So energy companies, because people just have to buy gasoline, write up their gasoline once they got it refined. Because it's up to $4 and the gas stations are still filled. So they know they're going to sell their gas. So they have some special rules. consistency. You got to use the same principles every year. If you're doing things a certain way, you got to do it that way every year. And we'll get into that when we get to inventories. Objectivity, and we want objective information, which is what you pay for something. We don't want any guesstimates. Accrual basis accounting, whenever the work has been done, we're going to accrue the revenue. So that's the accrual method. So we were doing those journal entries 15, that's because of the accrual basis. It makes more sense to know about revenue when it's been earned rather than waiting for the cash to be received. Even so, the cash flow prospects are very important. So we'll get to the statement of cash flow. So we use accrual basis, but then we still got to, at the end of the day, when the month rolls around, I don't care what income you got planned on coming in, on the first of the month, you got to pay your rent. So a company's got to pay its rent, it has to pay its employees. So we always want to assess that. So any questions on anything we covered in terms of these principles that you'll be tested on? So
I
go
had
and
a question.
yes.
So when you say we're going to be tested on this, you mean like we're going to be taking like a multiple choice test?
Well, I'm gonna give you an essay
Yes.
test. Everybody else, I'm gonna give a multiple choice test too.
You want to give me
Since
a what?
I'm gonna give you a essay test, but everybody else I give a multiple choice.
That doesn't sound good.
Here's what your income statement should now look like: sales, less cost of goods sold, gross profit, less the operating expenses, net income, tax liability, net income. So you were just throwing things down before, but now you want this your income statement looking like this. Statement of retained earnings doesn't change, but when we do balance sheet, we typically do 2 years together. So when we do balance sheet, we're always going to have 2 years. And so here's some multiple choice questions for you to practice on. So it's probably a good idea to go through these 26 multiple, no, 26 of them. So go through those 26 multiple choice questions. So that's typically how your exam will reflect that. You know, multiple choice questions. So you get some multiple choice. You know, you get a little break. So everybody know how to make debits and credits now, and let's get back to this accounting cycle. We start off with step 1 and 2, how to analyze transactions and make journal entries, and most people can do that now. Then we post it to the ledger and prepare the trial balance. Most people can do that now. And then we did step 7 and 8. We prepared the financial statements and closed the accounts. And step 9, post-closing trial balance. That's just the balance after you make your closing entries. You want to make sure you're still in balance. So the permanent accounts, you prepare a trial balance to make sure you're in balance. But now we're going to come back to steps 5 and 6, adjusting entries, and of course the adjusted trial balance. If you make these adjusting entries, you're going to have a different trial balance. Most times I'll have you make the journal entries, then I'll have you make the adjusting entries, and then you do the trial balance, adjusted trial balance. I have you only do it once. Sometimes people do it twice. They do it before the adjusting entry, they do it after the adjusting entry. So that's not a big deal. The big thing about adjusting entries is I no longer tell you the dollar amount. Okay? I no longer tell you what the dollar amount is. So you got to calculate it. Basically, we know what the accounts are and the entries are, but I don't tell you the dollar amounts anymore. Okay, so let's see if we can move to adjusting entries. And that little aspect sometimes causes problems for people. What do you mean that somebody told me you didn't give us the amounts? Okay, so journalizing and posting adjusting entries, and this, of course, is all in the primer. So this talks about adjusting entries that are made on the last day of an accounting period, typically. And they ensure that, we talked about the accrual method and the matching principles. They ensure that these items occur. They ensure that the income statement only reports revenues and losses and expenses that are incurred during that period. It ensures that the receivables and liabilities on the balance sheet represents the true amount. And so the key thing, your statements are accurate. Without adjusting entries, your statements would not be accurate. So let's see if we can look at the rationale behind adjusting entries. Now, on page 37 and 38, we had that JSJ Publishing Company, and we had that journal entry, 2 journal entries. We had a journal entry where you bought supplies paying cash. Then we had another journal entry where you bought supplies on account. So there's a journal entry that was made. You debit supplies, credit cash, a type 7. Then you did a type 12. You debit supplies for $8,000 and credit the cash for $8,000. So right now, how much is in the supplies account? $9,000. Okay. But we come to the end of the year and you take an inventory, you only got $3,000 in supplies left. So we come to the end of the year and you only got $3,000 in supplies. So what you gonna do? Are you gonna leave the supplies on the books at $9,000?
No.
No.
What you gonna do?
Subtract them.
How we gonna do? So how much supply did you use?
6,000.
6,000.
And the way you look at that, if you had $9,000 in the bank at the beginning of the period, you had $3,000 in the bank at the end of the period. So what does that mean? You spent $6,000. So in this case, we spent so you had $9,000, but now you're down. And so therefore that means we make an adjusting entry and we're gonna put that amount in the expense. So we debit supplies expense and credit supplies for $6,000. That is an adjusting entry. Okay? That is all an adjusting entry is. So this is the adjusting entry. It never changes. But you've got to calculate the amount. So we tell you that this is a type 13. Okay? So in this 13.
So essentially, what is the point of it?
Essentially what?
I said, so essentially, like, what is the point of like trying to adjust it if it's gonna be if nothing changes?
Something does change.
Oh, I thought you said it didn't.
It does. Suppose you had $9,000 in the bank at the beginning of the month and you got $3,000 at the end. Has something changed?
Yeah. I thought you said it didn't change. My bad.
Yeah, it changed. Okay. So what happens is we got to get this balance in the supplies account to $3,000. So we make the entry debiting supplies expense and crediting supplies. Supplies is an expense account. Okay. So eventually you're going to close supplies out. So another thing in looking at assets, we call them prepaid assets, because eventually these items are going to be come on the income statement as an expense, and you're going to have revenue. So you don't buy any asset, autos, land, building, unless they're going to generate some revenue, because eventually they're used up, and you got to have revenue to cover all your expenses. So any question on why we make this adjusting entry for supplies? Any question about the rationale for this? Because I expect everybody to be able to go to your problem that you have, put in all your debits to supplies, you got an ending supplies amount, and make the adjusting entry. But we'll let you all practice in a few minutes. Okay.
Oh, so that's what supplies expense is, right? It's,
Yep,
it's the amount of money that has been used, right?
that's correct. It's money
Oh, that makes so much sense now, because I remember seeing supplies and supply expense, but I never knew if they were the same or they were different.
they're different. As long as you got the asset, got the item, it's an asset. But once you spend it, it's an expense. Suppose you bought.
I always thought we were spending money on supplies
We did.
versus a supplies expense.
All right,
Damn,
Neely.
this confusing.
All right, Neely. You go to the store and you buy 10 steaks, okay, at $10 a piece, and you put them in your refrigerator. What you got in your refrigerator?
Steaks.
$100 worth, right?
Right.
And you have a couple of roommates, you know. You get to the end of the month and you get ready to check on your steaks, and you only got 3 steaks in there now. So you had 10, now you got 3.
Mm-hmm.
So what's happened?
I lost my steaks. I lost my money worth. $70 worth.
Okay, so that's what's happening here. We had $9,000 worth of supplies. People use the supplies.
Oh, okay. Okay, I get what you mean, baby.
Cups and pencils and paper and on and on and on. And so you bought it. Now you don't have that amount. So just like your steak's gone, and that's kind of an expense, right? So when you buy this, they're an asset. It's only when they're eating that they become an expense.
Right.
Okay?
Okay. Makes sense.
Good. So we have 4 types of adjusting entries, and today we're just going to look at these on the left: prepaid expenses and unearned revenue. Then on Tuesday, we'll look at accrued revenue and accrued expense. So anytime you buy an asset other than cash and receivables, inventory is on down, we leave land alone. It's a prepaid expense. It's waiting to be expensed, just like those supplies. So you need to have some money coming in, because eventually we're going to have to move it from being an asset and put it in the expense side. Then we have unearned revenue. Now, what is unearned revenue? Unearned revenue represents money you get for your business in advance before you provide the service. So let's look at GameStop. Let's look at Nike. Nike has 1,000 Jordans coming into Houston, but that's all that's coming. But there's some people who got to have those Nikes, the latest version, the 2021 version. And so they go and they give the shoe company their money in advance. You got my money in advance. When the shoes come in, call me and I'll get it, because they want to make sure they can get the shoe. And so they pay money in advance. gains, special gains. People want the game. It's a limited number. So what do? I want it, I pay it in advance. So has anybody here ever paid for things in advance? Anybody in the house ever paid for something in advance?
Yeah.
Okay. So let's look at what I want to now do is to move to the point of being the person who runs the company who get the income in advance. So it was nice that you paid for it in advance, but now you're a big business student or entrepreneur and you're going to have people pay you in advance. Isn't that a much better situation?
Yes, sir.
Okay. So that's what you learn how to do. You're looking at the other side of it, how happy these people are that they have your money. When you make adjusting entries, remember two very important rules. First, cash is never involved in adjusting entry. I'm going to say it again. Cash is never involved in adjusting entry. And I'm going to say it a third time, Chelsea, so they can't say that I didn't say it 3 times. Cash is never involved in adjusting entry. Now, cash may have been involved in the preceding entry where we bought the supplies, or when we eventually pay something. But when you make that adjusting entry, no cash. Second, adjusting entries are going to involve an income statement account and a balance sheet account. Now you got your chart of accounts right. On the left are the assets and liabilities, the balance sheet accounts. On the right are the revenues and expenses. So when you make an adjusting entry, you got to have one account on the right side of the chart of account, another account from the left one. One account, one side, the left side, which is those assets and liabilities, that's got to be involved in the journal entry. Then another account from the right side of that chart account, the revenues and expenses. So you see that chart of account. But in general, we'll know what's involved. So this is not as hard as it sounds. You just got to calculate the amount. Okay? So we're going to have an income statement account and a balance sheet account. We'll come back to prepaid expenses. Because you may not have had a prepaid expense. Did I get too far? So we're going to look at unearned revenue first because people say they have paid for things in advance. So as we said, that occurs when somebody's getting their money in advance. And boy, that is just the best situation. That is the best situation. So when there's unearned revenue, we're going to debit cash and credit unearned revenue. What type is that? If you look at your chart of accounts, which you're supposed to have in your lap, what type is it? We debit in cash. What type is it? I forgot those journal entries already. Don't I have some A students in here? I'll let you look at it. Airlines and magazine publishing companies get you to pay in advance. Okay.
What was the question again?
What type of journal entry is this where you debit cash and credit unearned revenue?
Type 4.
Is that
Income
a type?
received in advance.
Okay, that's a type 4. So now we move into additional types. If cash is coming in and debited, it's got to be in that 1 through 6. So now we're beginning to cover the rest of those. And so when you get the cash, that's the preceding entry. All right, it's okay to have cash. So let's look at our example. Assume GameStop collects $50 in advance from 200 customers for a game that's going to arrive in 2 months. 2 months later, the games arrive and are picked up by the customers. So when GameStop gets the money, it debits cash and credits unearned revenue. Type 4. What kind of account is unearned revenue? On your chart of accounts. What type of account is unearned revenue?
0305.
Credit.
So is it an asset, a liability, or what?
Liability.
It's a liability, because when you get the money, when GameStop gets your money in advance, they have not earned it. So it's not revenue yet. So they got the cash, which is nice. They just got to get those games, get them delivered, not have an ice storm that keeps them from coming, and get them to you. Then they've earned the money. So when the games come in and the customers pick them up, then they debit unearned revenue and credit sales. Nice way to do business. That's how you want to do business if you can. Get the money in advance, perform the service, deliver the games, and then you recognize sales. So it's not sales until the revenue is earned. When we get the cash, we debit cash and credit unearned revenue. Then when the games are picked up, when you come in and you pick up the games, then they debit the unearned account and credit sales. So it only becomes sales, goes on the income statement after the revenue is picked up. Any questions? So you just got to get on the other side of this. So when we got the money, we credit the cash and debit the cash, credit the unearned revenue. When we make the adjusting entry, we debit it and we credit the sale. So notice that the preceding entry did involve cash, but not the adjusting entry. Okay? The preceding entry involved cash, but not the adjusting entry. So now you can kind of see why I saved these. So, let you go through things where you don't have to overtax your brains. But now it changes, and you got to be thinking about not only what type it is, but how do I get to these dollar amounts? Unearned revenue is not that bad. That's one of the easiest ones. Let's move to prepaid expenses, and we will start on these today. How much time do we have left? 2:30, 3:15? We'll start on these today. We'll look at some examples, and then you'll begin to work them on next class period. Most assets are prepaid expenses. We debit the asset when acquired, and we're going to credit. We may not pay cash right away, but we got to pay the payable. So in that preceding entry, the prior entry, we debit the asset and credit cash. Prepaid expenses expire with time, such as prepaid insurance, or through usage, such as supplies. If you don't adjust your financial statements, assets are going to be overstated, expenses are going to be understated. So if you don't adjust it, you got these supplies on the statement, then the assets are going to be overstated, but your expenses are understated. And so an adjusting entry is required. So we make adjusting entries for supplies, for prepaid insurance, and for autos and buildings and equipment too, because they go down in value. So if you buy an auto for your building, for your business, it's going to turn into an expense as it loses value. So that auto better be generating some revenue. Let's go back to supplies again. We buy $5,000 worth of supplies. At the end of the period, we only got $2,000 of supplies. So what does that tell you? What's your adjusting entry going to be? We bought $3,000 worth of supplies. We take an inventory. We only got $2,000. What might our adjusting entry be?
$3,000 of supplies expense.
$3,000. Debit supplies expense, and we're going to credit supplies. So we have in the supplies account $5,000 at the beginning. There's only $2,000 left. So we're going to make this expense. And once we make this expense, supplies going to have a $2,000 balance. Now, you know that, okay, once something is an expense at the end of the period, we're going to do what? Close it out. So that the retained earnings reflects the proper amount. So this 3,000 is in effect reducing retained earnings. You want some revenue to reflect it. So this is the entry. Debit supplies expense, credit supplies. Well, here's our debit, but then we're going to close it out. So what I'm going to do is let you all go back to your spring break. I think some of y'all on spring break. But toward the end of your spring break, you come here next week and begin to read this material on adjusting entries. The next class period, we're going to do not only supplies, but we're going to do prepaid insurance. And you got an adjusting entry on your study problem for that. And we're going to do depreciation expense. So what I will probably do is to move the due date for your problems back to Tuesday or Wednesday, probably Wednesday. And that way we would have covered most of the adjusting entries that you needed. I think we'll have them all covered, basically. Be one or two others that we will look at. But you got to read this information. And then, as we normally do, we have journal entries. We're going to eventually get to these problems, adjusting journal entry study problem, 3-1. So you want to find 3-1, and I'm going to assign somebody each one of these problems. There's a whole bunch of them. So I like to have enough so everybody has an adjusting entry that they have to do. So it's 20 people in here. So we'll be doing about 20 adjusting entries on Thursday. With everybody got the adjusting entry, and that's how you're gonna get your homework. So
Professor Boyd,
yes.
are you going to post this in Blackboard?
What?
What you're showing us right now?
This notes.
It's in the primer.
Okay, I just wanted to make sure that it's there. Like, did you just post it or it's been there?
It's always been.
Okay.
You know that little book, that primer?
Yeah, I looked at that. I didn't see this. So I'm gonna look at it right now.
Look at it right now. See?
Professor Boyd,
Yes.
what did you say? Okay, you said something is due on Wednesday?
I said because I'm a nice guy, I would probably delay the study problem to Wednesday because there are a lot of adjusting entries in it. Okay?
Okay. Okay.
But you don't need it, do you, for a woman to just not change it?
I missed that. Say that again.